What's up, guys? This is Joel Robert. Just wanted to show you guys how I do some types of trading here. So this is what I call a short strangle, and this is just one of the companies that I think is pretty interesting. Innoviva is the name of the company. They're in the biotech field. Here's a chart for them, a little symbol there for you. So I threw up a quick little Fibonacci ratio that's pretty much based off of the top line here, is going off of some points that it hit, some high points, and then the low is based off of some low points that it hit. It actually did dip lower than that, and it did go a little bit higher than that, but this pretty much throws out some ceilings and floors that you can kind of see where it's hit them and kind of punch through, but then realize that, oh yeah, I shouldn't do that. Let me bop back. So you can see that these pretty much show up pretty well. If you even throw some Fibonacci ratios out to the future, you can kind of see, or even in the past, I'm sorry. If you go into the past, you can actually see where these same lines will be hit a few more times. You can even see right back here, around here, it's actually still hitting the same 1401 line. Numbers based off over there. So anyways, so what I do with a short strangle is I will buy 100 shares of a company. And for this one, like right now, they're going for $11.99 a share. I did not jump into this company. I may jump into it just for a little taste, get 100 shares to kind of go with you guys if you wanted to follow me and see what's going on. I'll try to post this video before the market opens. It'll be opening up in about, what is that, 5 hours-ish from now. So I'll try to post this video up before then. So anyways, you buy 100 shares in a short strangle, and so the share price is $11.99. And I went through to just go out for options. It's good to get something between 30 and 60 days out. That gives you some of the best returns on your money. I did not look at Innoviva to see if they have any like events coming up. Usually if they have earnings coming out, it could kind of spike the price or drop the price one way or the other. You don't really want that to go along with your shares of the companies. It could be very dangerous. But so 59 days out, 19 February 2021 is where you could actually sell some puts and some calls. The strike price that I looked at that looked kind of interesting to me was $10 for the puts. So that would put you on the hook to buy 100 more shares for $10. So like if you have a little over $2,000, you can do this same trade for one contract on the put side. And then since you bought 100 shares for $11.99, I looked at the $14 right here. So that's like, yeah, so the $14 call would let your shares be called away for you for $14 a share. And if you look at like the mark price, which is the split between the bid and ask prices, that's showing right now at like 32.5 cents per share. And then on the low side there for the put, the $10 is looking at a mark of 27.5 cents. So here's a little Excel spreadsheet that I threw out. So the company is Innoviva. Price $11.99 a share. Expiration 19 Feb, as we got right here, with the 59 days out. So it's a $14 short call, meaning you sold the call. Price at 32.5 cents. The short put, where you sold the put here, the $10 for 27.5 cents. Total premium there is 60 cents per share. So your net debit that you're coming out of your pocket with is $1,139, $1,139. Cost per share is $11.39, so you're getting at a 60-cent discount, which is 5%. That's your return on risk capital. Now, if you can do this trade throughout the entire year, you'll be able to do it 6.19 times if you do the little multiplier, because you can still do it until the next year, so it'll do 20% of one more version if you're doing the 59 days out. This is based off of the days to expiration is 59 days. So then your annual return on risk capital, if you can do this 5% return based off of your 60-cent discount per share, if you do that for the full year, you'll get 31% on your money. And that's finding some other companies that are also tasty like this one, looks good, and you want to jump on that kind of share. So here's the different ramifications. So that's just if you buy the shares and you're looking to buy Innoviva, you can get it at the 60-cent discount to be $11.39 a share. If you get it free and clear, and that's the same as the bottom one down here, the both out of the money. If both of the shares expire, or both of the contracts, the options contracts expire out of the money, meaning that the share price ends between $10 and $14 a share by 19 February 2021, you will have got $11.39 per share for $1,139. So that's what your initial price is. Now, if you put more shares, meaning you bought 100 more shares at the $10 per share price, that'll get your cost basis down to $10.70 a share. I expect that Innoviva is going to be way more valuable than this. I think they should be sitting at like twice this amount of money. And I like to take advantage of these companies when I find a 50% discount, and then I grab more discount, like the 5% down off of this price. So if you were to buy 200 shares, right now you buy 100 at $11.39 a share. You get your next batch at $10 a share, which is $1,000. That'll take a total of $2,139 out of your pocket, but you now own 200 shares at a cost basis together. The first batch that you bought and the second batch that you bought, the price together comes out to be $10.70 per share. And I still expect this company to be worth more than $20 a share in the future. So your return on risk capital for that would be 2.81% with a multiplier 6.19. So your annual return on investment on risk capital for the year is going to be 17.4%. So that's not as good as your risk capital for the first one, because I think that's pretty much based off of you spending more money, getting more shares, and now the share price is at this lower price. So also, if the shares get called away and you bought them or if your call option is based off of the $14 per share, if the share price goes over $14 a share, you will have your shares called away from you, but you still get to keep your put premium that you got earlier. So all of your premium gets kept, but you are now getting your shares called away at $14 per share, which will give you $261 from your initial investment of $1,139. So your risk capital, because you're putting the other $1,000 on the hook, we go ahead and call that your risk capital too, even though you never lost that $1,000 for buying 100 more shares. Your risk capital is still $21.39, even though you only spent $11.39 per share. So we'll call the return on risk capital of 12.2% based off of a higher number, because you should have that money in your account ready to make this trade if you have to, but you probably won't have to. If it goes up to $14 a share, you're going to be good. But your return on risk capital is 12.2%. So you made 12.2% on your money in just 59 days. Now, if you can do that for the full year, multiply it out, 6.19%-ish, your annual return on risk capital is going to be 75.5% on your money. So that's a great return for risking a little taste of money. For just a little over $1,000 invested, you will be returning 75% on your money for the full year. If you can find a good deal like this the whole time. You're not always going to be able to, but this is a good little play that you can have fun with. And I may be jumping on this tonight. Check it out, and see you guys later.